95% of trading is controlled by AI, banks, hedge funds, algorithms. Here are some samples of the way ChatGPT helps on a daily basis. Hey ChatGPT, generate the weekly report before we trade. Here is that report. Top 10 geopolitical risks affecting FX today are these. 1. Iran war/Strait of Hormuz disruption. This is the biggest live FX risk because it is driving oil and gas supply fears, inflation risk, recession risk, and violent repositioning across USD, CHF, JPY, Euro, and commodity-linked currencies. Reuters reports that Middle East disruptions have already taken more than 12 million barrels off the market and that the IEA expects April disruptions to worsen. 2. Headline risk around de-escalation or re-escalation in the Iran conflict. Markets are swinging on every signal about whether the war is winding down or widening. Reuters notes that hopes of a ceasefire weakened the dollar and pushed risk assets higher, but the messaging remains inconsistent and fragile. That means sudden reversals in USD, CHF, JPY, oil, and gold can happen fast. 3. Energy shock inflation repricing across central banks. The Iran conflict is no longer just a news event. It is now feeding policy expectations. Reuters says Fed officials see higher fuel and commodity prices as a potential source of sustained inflation, while ECB officials are openly discussing adverse scenarios and possible tightening later this year. 4. A weakening and less reliable USD safe haven bid. Reuters strategist poll says the dollar's safe haven appeal has been eroded by chaotic U.S. tariff policy and concerns about Fed independence. That matters because in past geopolitical shocks, the playbook was by USD. Now the market is more split between USD, CHF, JPY, gold, and even Euro in some episodes. 5. Eurozone recession risk from an extended oil shock. ECB officials have warned that the Euro area may already be moving toward the ECB's adverse scenario, and another policymaker said Europe could face recession if oil rises above $150. That keeps Euro highly sensitive to oil, inflation prints, and ECB rhetoric. 6. Japan stagflation/BOJ policy risk. Reuters reports that the Iran war is pushing up imported energy costs in Japan, raising inflation expectations while clouding growth. That creates a difficult BOJ setup and keeps JPY vulnerable to abrupt policy repricing or haven buying. 7. UK financial stability risk from the same energy shock. The Bank of England has warned that the Iran war has increased threats to financial stability and sharply lifted gas and petrol costs. That makes GBP more exposed to inflation growth tension and rate path repricing. 8. Russia-Ukraine escalation, especially around energy infrastructure. Reuters reports Russia rejected an Easter ceasefire proposal and Ukraine continues pressure on Russian energy assets. That matters for Euro, oil, regional risk appetite, and broader inflation expectations. 9. OPEC Plus response risk after the oil spike. Reuters says the OPEC Plus monitoring panel is expected to discuss the recent surge in oil prices at its April 5th meeting. Any hint of extra supply, no change, or internal disagreement can move oil first and FX second. 10. China-Taiwan/South China Sea flashpoint risk. This is not the top market driver today, but it remains a serious secondary tail risk. Reuters reports rising Chinese military pressure on Taiwan and persistent South China Sea tensions involving the Philippines and China. If the Middle East war distracts Washington further, traders will price this risk more aggressively into Asia FX. For this week's top economic reports, the biggest ones on the board are U.S. President Trump's speech on Wednesday. In the current environment, this is effectively a macro event because any signal on Iran, military duration, tariffs, or the policy stance can hit USD, oil, gold, and risk sentiment immediately. U.S. non-farm payrolls on Friday. This is still the key scheduled macro release of the week for FX because it can shift Fed expectations fast, especially with markets already worried about an energy-driven inflation shock and a softer labor market. U.S. average hourly earnings M/M and year-over-year on Friday. In this environment, wages may matter almost as much as payrolls because traders are trying to judge whether inflation pressure is broadening beyond energy. U.S. consumer confidence on Tuesday. This matters because it helps show whether the oil shock and geopolitical stress are starting to hit households. U.S. ISM/manufacturing data on Wednesday. This is important for growth versus inflation pricing, especially after the March energy shock. U.S. weekly jobless claims on Thursday. Normally second tier, but with payrolls the next day and concern over labor market softening, claims have more market value this week than usual. So the clean trading takeaway is this. The live macro engine is geopolitics, oil/gas inflation expectations, central bank repricing, FX rotation. Right now, the most sensitive pairs and assets are US dollar to Swiss franc, US dollar to Japanese yen, euro to US dollar, pound sterling to US dollar, oil, and gold. Bar chart, BOB weighted score. Gold right now trade bias. Long gold factor points, H1 sweet spot swarm trend plus, 150D, 1 uptrend bias plus, 200 Iran war escalation, plus 300 oil shock/inflation risk, plus 150 USD weak safe haven, plus 100 momentum breakout funds, plus 100 total score, plus 1000 extreme buy bias. Direct hit, what you should do. Pro level execution. White heavy checkmark, best strategy right now 1. Wait for pullback. 2. EMA 50. H1. Previous breakout level minor consolidation zone 2. Enter only when. Green arrow print stochastic turns up from oversold. MACD supports 3. Risk control. 1% to 2% max. Let runner ride trailing stop. Come and join us at Bob the Trader GPT and we will teach you how to trade in a whole new way. Trade like a fund manager guided by AI. For full details, go to Amazon for a copy of our book.